Let's jump back into inventory measurements. This is the third video for chapter 8, and this is going to be the main video that really covers the different types of measurements. So let's start with just looking at the inventory cost flow, because anytime a company buys merchandise that they are planning to resell for money, that is going to be inventory, and chances are it's going to cost a different amount each time that you buy it, whether it's more or less. Unfortunately, we're typically in times that prices increase over time, right? So we're going to look at Galactic Gadgets. This is their inventory for 2025. And they didn't make a lot of purchases. They didn't make a lot of sales here, but this is just to make it simple. So they began the year with 6,000 units. Those units they had paid $4.50 each for. So you see we're going across the top here. And so 6,000 units times $4.50 is $27,000 total of inventory they had coming into 2025. So that's their beginning inventory. Then here's the 3 different purchases that they made throughout the year. On January 17th, they purchased 1,000 more units. The price had bumped up to $5 a unit. Just follow it across. When we multiply 1,000 units times $5, it's $5,000. March 22nd, we buy another 3,000 units. Now the price is going up to $6. 3,000 times $6 is $18,000. And then October 15th, we bought another 3,000. The price has gone up even more to $650, meaning our total cost on October 15th was $19,500. So the total units in inventory, as you see totaled up that were available for sale sometime throughout the year, were 13,000. The total cost of those units were $69,500. Then here below, we see that what the sales are for the year. So they sold 2,000 units on January 10th. They sold 2,500 units on April 15th, and they sold 3,000 on November 20th. So if we calculate all of those, they sold 7,500 units. So the question is, how much did those 7,500 units cost? And we're going to see several different methods, 4 different methods of how to calculate this. Allocation of cost of goods available for sale. So again, we began with 6,000 units that totaled $27,000. Then we purchased throughout the year another 7,000 units, varying prices, but those added up to $42,500. So our total goods available for sale were 13,000 units that totaled $69,500. Maybe you want to rewind, take a picture of the last slide so that you're able to keep up with where all those came from, but that's up to you. So when we're calculating the units available for sale, we would just take that beginning inventory, the 27,000 plus the purchases of 42,500. Our total units available for sale cost us $69,500. That will also equal our ending inventory plus our cost of goods sold. Now, we don't know, because it's based on which method we use, what was the cost of the inventory on hand, the ending inventory, versus what was the cost of goods sold. And that all depends on which method we use. We know the total is $69,500 because that's how much we had available. So how much you had available is going to equal how much we have left plus that we sold. So we're going to work through how to figure out the ending inventory and the cost of goods sold. So first, let's look at the most rarely used method, which is specific identification, and you'll see why this is the most rarely used. This is where the actual cost of each specific item is tracked and assigned to the cost of goods sold when that exact item is sold. So a good example of this would be cars. But we're not going to use cars in our example because we have galactic gadgets. So we're going to use UFOs. So we're going to have 3 different types of UFOs. They're all very different and they all cost us a very different amount. So we can't just average the cost or anything like that. We need to know specifically what did each of these UFOs cost us, and then we know how much to sell them for to be able to make a profit, and we can track those costs. So this first UFO cost us $50,000. I don't know if that's a good price for a UFO or not. I've never been in the market for it, but it was $50,000. So we're going to keep track of that price. Then we have the second really fun looking UFO. This one was 75,000. It's a little taller, maybe has a little more space in it, maybe for taller aliens. Then we have this final very top of the line UFO that actually will travel to other planets. So that one is a whopping $1.5 million. So, with a product like this that we are selling, we can't just average the prices or say, oh, we'll just kind of put them all in one basket, because they vary in cost to us so drastically that we have to say, no, this specific UFO cost us this specific one cost us that. So, yeah, a more relatable example would be cars. So, if you've got a car where you're a car lot and you're selling a Lamborghini and a Kia, well, those prices are going to vary a lot. We can't just average those out. So we would use specific identification. But if it's not something large that has a serial number that's really easy to track, we're not going to use specific identification. So this is all we're going to talk about with specific identification right now in this chapter. So let's move on to the other three methods that we'd be way more likely to be using. Average cost. This assumes inventory cost is a mix of all the goods available for sale. Like, look, we're selling bars of chocolate, and we're just putting them all in one big bin, and people can grab one out whenever they want it. We're just going to average the cost together. Some may have cost us a little bit more to make because, the prices had increased over time, but we're just going to average the cost together. So the average is weighted by the number of units. Then we have first in, first out, which we're going to call FIFO. If you've worked at a restaurant, you've probably heard of FIFO a lot. And this is saying that the first units that we acquired are the first ones sold. If you work at a restaurant or a grocery store, it's like, okay, the first gallon of milk that we bought is the first one we want to sell. And why is that? Because it's perishing, right? It's expiring. So if we want to sell the oldest thing first. The oldest meaning it was the first thing we bought. We want to sell those first. Now, I will say, and we're going to look at this later, but it doesn't mean that because the physical flow is that way, because we want to sell the oldest milk first, that we have to do the accounting that way. We don't have to do it like that. So we'll talk about that more later. But a lot of times companies do use FIFO. Then the ending inventory is going to consist of the most recently acquired units, because we already expensed out in cost of goods sold the ones that we had purchased that were older. Then last in, first out, also called LIFO, assumes that units last acquired are sold first. So ending inventory is going to consist of the oldest cost, or the first things that we acquired. So let's jump into this more with some examples. If you took a picture of that original amount that we spent on everything per unit, that'd be helpful. Here they are again to an extent. So when it comes to the average cost method, we're going to look at each of these periodic and then perpetual. So the weighted average cost is only calculated at the end of the period when it's periodic inventory. Okay, so they're only doing that physical count, and they're only, taking it out of purchases at the end of the period. Remember, if you don't remember that, go back and watch the prior videos for chapter 8. So beginning inventory was the 6,000 units. Then we added in all these purchases. Then we have our goods that were available for sale were 13,000, less our ending inventory. So our ending inventory at this point, we're going to just, with periodic, we're just going to take all of those units that we purchased, which totaled $69,500 worth, divided by the 13,000 units, and that tells us on average we spent $5.35. So that means if we have 5,500 units left in ending inventory, which is what we have here, we had 13,000, we sold 7,500, so we have 5,500 left. We multiply that times the average amount, the $5.35, and bam, that $29,425 is our ending inventory. Then for cost of goods sold, we said, okay, we sold 7,500 units. We're just going to use the average amount, and that was $40,125. So that's our cost of goods sold. Very simple to use average cost if it's periodic, but we're going to jump into doing it perpetual as well. Okay, so average cost perpetual. This is applied by calculating a moving unit average because each additional inventory item that's purchased, we need to calculate a new moving average. The new average is determined after each purchase by adding the cost of the previous inventory balance plus the cost of the new purchase. Then we divide it by the total number of units on hand. So we have previous inventory balance plus cost of new purchase divided by number of units on hand. So maybe take a picture of that, keep that formula there with you, and we're going to jump into our same example and we're going to look at how to calculate this. A lot more into it, right? Okay, so we've got on the left-hand side, we're going to show anything we purchased. Then in the middle, anything we sold. And then on the right, our ending balance after our purchase and sell. So we're going to see this in all three of these methods when we use perpetual. So we saw periodic, now we're looking at perpetual. So we have the $6,000 at $450, so that's our balance. Then we sell $2,000 at $4.50. We saw the dates of what we sold on that first slide. So we know it's $4.50. That's all we had in inventory. So the 2,000 units times $450, that was $9,000, which is our cost of goods sold. We had 6,000. We sold 2,000. So now our ending balance there on the second line under balance is 4,000 units. They were $450 each. So it's a total of 18,000 in ending inventory. Now we purchase another 1,000 at a new price of $5, which totals $5,000. So we take the 1,000 units and the 4,000 units. We have a total of 5,000 units now, and we need to calculate the average. So you see the first bold line there. To calculate the average cost per unit, we have the 18,000 that was already in our ending inventory as of January 10th. And then we add in the 5,000 we just spent, which is 23,000. We divide it by our 5,000 units we have in total, and that gives us $4.60 per unit that's going to be showing up in our ending inventory. So now we have right above that 5,000 units at $4.60 each. We have 23,000 in inventory. Then on March 22nd, we purchased some more inventory. We purchased 3,000 at $6 a piece. So now we have another 18,000. So we take the 23,000 from above, from January 17th. We add this new 18,000. We divide it by our total of 8,000 units. So now our average amount is $5.12 or 13 cents, 12 and a half cents per unit. Then we sell some on April 15th. We don't have to recalculate an average on April 15th. We're just going to use that $5.12 times the 2,500 units we sold. So our cost of goods sold on April 15th is $12,813. So now we have 5,500 units left at the $5.12. So our total ending inventory as of April 15th is $28,188. Then we purchased another 3,000 at $650. So we put in another $19,500. So we're going to take our ending balance of $28,188, and this is our third bold line that says average cost per unit, plus the $19,500 we just spent, divided by the total units that we have now of 8,500. That gives us an average unit cost of $5.61. We multiply that times the $8,500, and we have $47,685 in ending inventory. Then November 20th, when we sell more, we don't have to recalculate the average. We just say we sold the 3,000 at that cost that we just calculated. So total cost of goods sold on November 20th was $16,830. The 5,500 units that are left over are going to stay at that $5.61 until we purchase more, which we're not going to do in this chapter. So with the average cost, we had cost of goods sold, that bottom number in the center, of $68,643. That was just adding the cost up, the $9,000, the $12,813, and the $16,831. Our total cost of goods sold for the year was $38,643. Then our ending balance in inventory using the average cost in perpetual inventory is $30,855. Now let's jump into first in, first out, and last in, first out, and then we'll be done with this video. I don't want to overwhelm you too much. This is a lot. So, okay, remember we're going to look at periodic first, which we don't use a ton, but we're going to look at periodic first, accounting as if the first units acquired are sold first. So with periodic, we didn't keep track of it on a regular basis. So instead, we just say, okay, total, we had 7,500 units that we sold. So we're just going to go to the first units we bought, and we say, okay, 6,000 at $4.50, 1,000 at $5, and then to make it a total of 7,500, we'll go from our March 22nd purchase, and we'll take 1,500 of those at $6. So our cost of goods sold come from the first 7,500 units that we had on hand, which totaled $35,000. We still had another 2,500 left over for March 22nd, and we still had another 3,000 on October 15th. So when we calculate those, we have a total of 34,500 in ending inventory. So here we're saying the first ones we sold are the first ones out. And since we're using periodic, we're just saying, okay, we'll just take it all and show it as show it at the end. We didn't calculate it as we go along. But in reality, we would be calculating it as we go along. So here's what it would actually look like with perpetual inventory, which is going to be used at most companies, especially ones that we're going to be doing the accounting for in our homework. So with perpetual, same idea as, we're going to be following along with how much we purchased, we sold, and then the new balance, just like we did with the average inventory. We know we started out with the 6,000 at $4.50, totaling 27,000. Then we sold 2,000. Well, that's fine. We had to have sold the ones that were $4.50. So now we have 4,000 left over at $4.50. Then on January 1st or 17th, we purchased another 1,000 at $5 a piece. So here we don't average them together. We keep it separate. We take the 4,000 that we had left January 10th. We bring it down, and then we add in the 1,000 we bought at $5. So we keep them separate. We need to know which we bought first and which we bought next. When we add those together, we come up with 23,000 that we spent on that inventory. And then we purchase more on March 22nd. So we pull these down. You see, it's the same things, 4,000 and 1,000. We just pull those down, and then we add the 3,000 at $6 here. Then when we sell some, it's the first ones that we bought are the first ones going out. So we take the 2,500 units that we sold. We're going to go to the first ones. Okay, we can get all 2,500 from the $4.50. So we'll say the cost of goods sold was $4.50, making a total cost of goods sold for that sale of $11 or $11,250. We had 4,000. We sold 2,500, so now we bring everything down the same, except we only have the difference left. We only have 1,500 left at $4.50, and these we haven't sold yet. Then we purchase some more, so we pull all this down and add the new ones. So we've got all of these keeping it in line. Then when we sell our, how many did we sell here? We sold 2,000 or 3,000. When we sell 3,000 on November 20th, we are going to take the first ones in or the first ones out. Well, that's only 1,500, so we need to go to the next ones. Okay, so we got 1,000 at $5. We're going to assume it's cost of goods sold. Well, that's only 2,500. We sold 3,000. So we need to go to the next line here, and we've got another 500 that we sold at $6 a piece. So we've gotten rid of these first two layers, and we only have 2,500 left of the $6 a piece. So we pull those down. So our ending inventory, did not mean to hit that. Our ending inventory is 34,500, and our cost of goods sold 35,000. I know it's a lot. You might have to slow it down or watch it multiple times. All right, let's jump into LIFO. Very similar. If we do periodic, we're just going to say we're accounting for the last items we bought are going to be the first ones out. So here with periodic, we're not doing it until the end of the period. So we're saying, okay, we're going to take the Last ones here, and these are the ones that were sold, the ones that we purchased last. Those are the 7,500 that we sold. And then that just leaves us with 5,500 of beginning inventory. That would be all that was left in ending inventory. So with periodic, we just take all of it, take the big picture. We say it as if we sold the most recent purchase towards the end of the period first, and then we work our way backwards. All right, hopefully all of this is a refresher from financial accounting, hopefully. All right, finally we'll go through LIFO perpetual. So we do the same thing. Okay, all we have for the first sale is the 450, so it's going to be the same in all the situations. Then when we add in these next two, we just pop them on there just like we did on the other. But it's when we sell them that we are this time going to go after the most recent purchased. So we had 3,000, we sold 2,500. We're going after that, the most recent purchase. And so we're going to apply that at $6. So it'll be the most recent cost to us, or what we're going to show in cost of goods sold. And that leaves us with $500 there, and these are the same. We haven't sold any of those older ones yet. We add another layer to it. We have another 3,000 at the bottom. We keep that 500 at 6. We add another 3,000, and then when we sell 3,000 here, it's all coming off the most recent. So that would give us cost of goods sold of a total of 43,500 and ending inventory of 26,000. So it varies a good bit when the prices are changing. So let's compare, and I'll end the video here because this is a lot and maybe you want to watch it a couple of times. So our cost of goods sold under average, FIFO, and LIFO varied a lot. And that means ending inventory varied a lot. But at the end of the day, the goods available for sale were all the same. But this just all has to do with how quickly or at what point we're expensing out the items that we most recently bought or that we purchased a while back, or if we're just smoothing it out with the average inventory. So during inflationary times, FIFO will result in a lower cost of goods sold because it's older items, and the higher ending inventory under LIFO. If it was deflationary times, prices are decreasing, FIFO will result in higher costs of goods sold and lower ending inventory. Of course, most of the time, even if it's not as significant as we've seen lately, most of the time we are experiencing some degree of inflation. So we'll typically see higher cost of goods sold with LIFO. And we'll talk more about that and how that affects our financial statements and our taxes in the following video.